Wealth doesn't protect you from financial shocks, but it surely changes the shape of them. In fact, the richer you become, the more complex your financial life usually gets. You have more assets, more moving parts, and more decisions to make. And with that complexity comes a different kind of financial exposure. Wealthy households are often less worried about paying next month's rent, but they're far more exposed to shocks involving liquidity, legal structures, timing, and long-term positioning than the average household. And so today we're going to talk about the most common financial shocks that affect wealthy households and why net worth alone doesn't equal financial resilience. Let's start by looking at what is a financial shock when you're wealthy. A financial shock for a wealthy household usually doesn't look like a survival crisis. It's rarely about groceries, rent, or utilities. Instead, it's often more about disruption. We're talking about a sudden event that forces decisions under pressure and permanently alters financial positioning. These shocks often affect assets rather than income, structures rather than cash flow, and long-term plans rather than short-term comfort. A financial shock at this level might mean being forced to liquidate investments earlier than originally planned. It might mean losing control over a business. It might mean a legal ruling that restructures ownership, or a liquidity crunch that turns paper wealth into a problem. What makes these shocks dangerous isn't that wealthy households can't recover, it's that recovery often comes with irreversible consequences. We're talking about missed compounding, lost control, tax inefficiency, or even reputation damage. When finances are complex, shocks don't just hurt in one place. They ripple across the entire system, and the more complex the system, the harder it is to absorb stress cleanly. The first shock is the lack of liquidity. On paper, net worth may be high, even very high, like millions or billions of dollars. But much of that wealth is often locked up. Think about real estate, private businesses, private equity, or even long-term investments. So we're talking about illiquid assets that can't be easily converted into cash without consequences. The shock happens when cash is suddenly needed. For example, a tax bill, a legal settlement, a capital call, a business downturn, and despite having millions in net worth, the household doesn't have enough liquid cash to respond comfortably. That's when stress sets in, because the options aren't great. Borrow at unfavorable terms, sell assets quickly, take distributions at bad times, or give up leverage and control. Liquidity shocks are especially painful because they feel paradoxical. You're wealthy but constrained. And once forced decisions are made under time pressure, they often create long-term drag on wealth that can't be undone. Liquidity isn't about returns, it's about flexibility. And many wealthy households don't realize how little flexibility they actually have until they're forced to find out. Another major financial shock for wealthy households comes from equity concentration. This happens when a large portion of wealth is tied to a single business, industry, or investment. Often, this concentration is what created the wealth in the first place. A successful company, a fast-growing sector, a long-running investment that paid off, and because it worked before, it feels safe. But concentration amplifies risk. When something goes wrong, like a market shift, a regulatory change, a competition, a technological disruption, the impact isn't gradual. It's actually immediate and severe. Wealth that looked stable suddenly becomes volatile. And because diversification often comes later, after wealth is built, many households stay exposed far longer than they realize. The shock isn't just financial, but emotional as well. Identity is often tied to the concentrated asset. Letting go feels like giving up control or admitting uncertainty. But when diversification happens too late, the opportunity cost can be enormous. Equity concentration shocks don't just reduce wealth, they permanently change future earning power and optionality. Next, legal issues are one of the most disruptive financial shocks for wealthy households because they introduce uncertainty, duration, and loss of control all at once. We're talking about divorces, lawsuits, inheritance disputes, and partnership conflicts that can freeze assets, delay decisions, and force disclosure. These events often drag on for years. During that time, legal costs accumulate, stress compounds, and outcomes are uncertain until the very end. Divorce, in particular, can restructure wealth overnight. Assets are literally split and cash flow changes. Ownership gets redefined, as well as tax consequences quickly follow. Lawsuits can threaten not just money, but reputation and future opportunities. Inheritance disputes can fracture families and delay asset transfers indefinitely. What makes legal shocks especially damaging is that they often hit multiple layers at once: the financial, emotional, relational, and strategic. And because legal outcomes are outside personal control, planning only goes so far once the process starts. Wealth increases legal exposure simply by existing, and without strong structures in place early, these shocks can cause lasting damage well beyond the initial event. Another one is forced selling. This is one of the most painful financial shocks for wealthy households because it combines bad timing with permanent consequences. This happens when assets must be sold regardless of market conditions, often due to tax obligations, business losses, margin calls, legal settlements, or liquidity needs. The problem isn't just the sale, it's also when the sale actually happens. Selling during a downturn locks in losses. Selling under pressure removes negotiation power. And selling to meet obligations means those assets can't recover later. What makes forced selling especially dangerous is that it breaks long-term strategy. Wealthy households often plan around holding assets through cycles. Forced selling destroys that advantage. And once assets are gone, the future income, appreciation, and control they provided disappear with them. This is why liquidity planning matters so much at higher net worth levels. The shock isn't the loss itself. It's the lost future that sale would have created. Now, lifestyle inflation creates a quieter but very real financial shock risk for wealthy households. As income and wealth grow, lifestyles expand. We're talking about private schools, multiple homes, staff, travel, or even long-term commitments. None of these feel risky individually, but together they create high fixed costs, and high fixed costs reduce flexibility. When income fluctuates, assets underperform, or businesses slow down, these costs don't adjust quickly. The household may still be wealthy, but cash flow becomes strained. Decisions become reactive. Stress increases. Lifestyle inflation isn't about overspending, it's about rigidity. The more complex and expensive the lifestyle, the harder it is to adapt during change. And that makes wealthy households vulnerable to shocks that wouldn't otherwise be destabilizing. The issue isn't luxury, it's dependence. When lifestyle costs depend on volatile income or asset performance, even small disruptions can feel surprisingly severe. Another one of the most damaging long-term financial shocks affecting wealthy households happens across generations. Poor succession planning and weak estate structures can quietly destroy wealth that took decades to build. When assets aren't transferred clearly, efficiently, and intentionally, disputes arise. Taxes increase, control fragments, businesses suffer, families fracture, and wealth leaks away through inefficiency rather than spending. The shock often comes after death or incapacity when decisions must be made quickly and emotionally. Without clear plans, heirs may sell assets prematurely, fight over control, or mismanage responsibilities they weren't prepared for. What makes this shock especially painful is that it's avoidable. And yet it's extremely common. Wealth doesn't automatically pass itself on. Without planning, it dissolves. Succession shocks don't show up as a single moment. They show up as a slow erosion of value, stability, and legacy. The takeaway from this video is that complexity without resilience is often the real risk. High net worth doesn't guarantee flexibility. It doesn't guarantee liquidity, and it doesn't guarantee control under pressure. Financial resilience comes from structure. Things like liquidity buffers, diversified income sources, clear legal frameworks, separation between lifestyle costs and volatile income, early estate and succession planning. Basically, net worth is a number while resilience is a system. And the households that survive financial shocks best aren't the ones with the highest net worth. They're the ones whose financial lives are designed to absorb stress without breaking. If this video helped you see wealthy financial stress in a different way, click on one of the videos on your screen right now. They go deeper into how financial resilience actually works across income levels and how to protect progress without relying on assumptions. I'll see you in the next one.